Let's review problem 23-8. This is a problem we had worked on in class. We had done the indirect method, and I'd like to go over this once again so that you have this for your reference before the exam. Just to make it easy, I have copied the entire problem onto my Excel file. So let's look at what we have over here. For Sharp Company, we have the comparative balance sheet, the balances as of December 31st, 2016 and 17. Instead of giving it as assets and liabilities and equity, they've given it as debit balances and credit balances. So what you will notice over here is you have allowance for doubtful accounts, which should be a subtraction from accounts receivable, and accumulated depreciation for equipment in building listed under the credit balances. Normally, those would have been accounted for under your assets as contra asset accounts. We've been given 5 pieces of additional information, and we've been given the income statement. In the income statement, something worth noting is operating expenses does not includes your depreciation expense and bad debt expense, but this information has not been given to us directly, and I'll show you how we can calculate those numbers. So we are going to prepare the statement of cash flows using the indirect method for Sharp Company for the year ended December 31st, 2017. We have our 3 sections: operating, investing, and financing. Operating activities, we're going to start with net income and work our adjustments. And at the very bottom, we're going to have the change in cash. I also have listed schedule of non-cash activities. If we have any, we will have that information down here. Now you'll notice I already have certain T accounts open, and I've done that just to make it a little easier as I explain. These are the only ones I want to open because it's something I need to look into. So the obvious question is, how do I decide which T accounts to open? So let me show you how I'd go about doing this. I'd start out by identifying the changes in all these accounts, all the balance sheet accounts. So from 2016 to 2017, my cash balance has increased by $19,000. So it's just a difference between these two numbers, and you identify whether it has increased or it has decreased. So I'm going to highlight this section to indicate that I've already done the calculations. And you'll notice there's only one account that has no change in it, and that's building account. So we'll see how to account for all these other changes and where we're going to put that information. And as I go through it, I'm going to highlight the account to indicate that I've taken care of it. Statement of cash flow is explaining the change from beginning to ending, and we need to account for the $19,000 difference. So that's what goes into at the bottom of your statement of cash flow. I know my cash balance has increased by $19,000, which means these 3 sections should add up to $19,000. When I add my cash beginning balance, I get my cash ending balance. So this information has been taken care of right now. So I'm going to put this in a different color to indicate it's been taken care of. I have accounts receivable, inventory, debt investment, equipment, building, and land. Under credits, I have accounts payable, income tax payable, long-term notes payable, common stock, and retained earnings. Once again, I told you, building, we have nothing to worry about because this number has stayed the same. However, I may have sold a part of a building or building and for the exact same amount, I may have made a purchase. The only way I'll know that is by looking at the additional data. So I start with that. Equipment that cost $10,000 and was 60% depreciated was sold in 2017. So I open the equipment account. I open accumulated equipment account. I've copied down my beginning and ending balance for equipment. Those are numbers over here. I've done the same for the depreciation on the equipment, the 14 and the 21,000. It's a credit balance because it's a contra asset account. Now what I've done for myself, and these are just notes, all of these T accounts and the notes, journal entries, notes, etc., they're just for my reference. What I'm going to do is I'm going to set up a journal entry for the sale of the asset. Okay, so hopefully I got some cash when I sold this asset. So I'm going to go ahead and put cash debit. I sold the equipment. What's the original cost of the equipment? $10,000. So I'll go ahead and plug that number in over here, 10,000. What was the accumulated depreciation on this item? The accumulated depreciation, 60% of 10,000 is 6,000. So I'm going to take that off my books, the $6,000. So the book value of this asset is $4,000. Well, did I get $4,000 cash? Did I get more or did I get less? How do I find out? Well, I got the equipment and accumulated depreciation on equipment information from the balance sheet. The additional data told me I have this equipment that's sold. Let's go down to the income statement. Here I have this information. I sold the equipment at a loss of $3,000. Okay, so the book value is 4,000. If I sold it at a loss, it means I got only $1,000 in that transaction. So loss on sale of equipment is a 3,000. That's from the income statement. Okay, so let's do several things over here. First, let's post this information to update these T accounts. My equipment I sold for 10,000. The equipment that I sold had original cost of 10, so I take it off my books. I have 6,000 that I need to take off the books because that equipment is not there anymore. The next thing I'm going to do is I'm going to put less gain on sale of equipment, $15,000. My mistake over here. I'm looking at the wrong item. My equipment sold at a loss, not a gain. It would be nice if I had a $15,000 gain. I add loss on sale of equipment, $3,000. Okay. And the $1,000, where does that go? Sale of equipment is an investing activity. So I will have sale of equipment, $1,000. Okay, so once again, cash debit, that came in over here. Accumulated depreciation debit, I put that into the T account. Loss on sale of equipment, I put that in the operating activity section to take it out from the net income number. And equipment credit, I put that in the T account in order to update that particular account. Let's look at the next piece of information. Cash dividends were declared and paid during the year. For this, it's always the retained earnings account I need to look at. Retained earnings, beginning balance, plus net income. I'll get that information from my income statement. I add the net income. I subtract dividends to get the ending balance. So I know the beginning balance, I know the ending balance, I know net income. So I plug the dividends number at $70,000. What type of account is it? Financing. So I paid dividends $70,000. I've taken care of this piece of information and I've taken care of my retained earnings. Okay. Next, I'm told common stock is issued in exchange for land. So I have my common stock account, I have my land account. Common stock increased from 260 to 310. If you look over here, common stock increased by 50,000. What about land? Land increased by 15,000. So what I can do over here is I can say land increase, the difference is $15,000. The $15,000 that it increased, that's the same number I'll have over here. Okay. Common stock in exchange for land is a non-cash activity. So I'll put that down over here. Common stock issued in exchange for land, $15,000. So if I had to do a journal entry, it would be land debit, common stock credit, $15,000. The next piece of information I have is debt investments costing $35,000 were sold during the year. So my debt investment, let me highlight this portion. I had 85, it's down to 55. How much did I sell? Something that I had in my books at 35. This is what I sold. Okay. Did I sell it at a gain or a loss? We can do the same thing, a journal entry like we had over here. I'm not going to do that now that you know how to do it. It's at a loss, at a gain of $15,000. Okay. So what's the total cash I got? $35,000 investment. I sold it at a gain of 15. Okay. Which means I sold it for $50,000. And that gain, that comes in over here. Remember, we subtract gains, so I wrote less gains over here. So my investment account, 85,000, 35,000 I sold. So there should be 50,000. There's 5,000 that it has gone up. We'll come back and take a look at it in a second, what that number is. Okay. There are no write-offs of an accounts receivable. So we'll again take a look at that in a second, what that means. Okay. So I'm going to go down the list with my operating activity section to work my way down over here. So to start with, net income number I know is 67,000. And remember, that was the same number we had put in our retained earnings, the 67,000. I always know I'm going to start out by adding my non-cash expense, depreciation expense. I need to work that number out over here. My accumulated depreciation, if I just look at these two accounts, it appears that it should be $16,000 depreciation expense. But we know that may not be true because I sold something over here. So let's hold off on that one, the depreciation expense. Okay. Accounts receivable. The last piece of information said there were no write-offs, and that's good over here. So what I would do always for accounts receivable, when the information is presented the way it has been for us over here, is I write down the beginning and ending balance of accounts receivable and the allowance for doubtful account. Okay. So if you notice, I put my allowance for doubtful account as negative numbers because they're a subtraction from accounts receivable. I calculate the change and see what I have over here. Okay. So what I'm concerned with is this number, the net increase. So when I come down to my operating activity section, I wrote that number last over here, but you can put that in any order. Increase in accounts receivable, I'm concerned with the net number. So accounts receivable and allowance for doubtful account have been taken care of. Then let's look at our other short-term liabilities. I have accounts payable, income tax payable. These two accounts, they both increased. Okay. And I missed inventory over here. I jumped the gun with payables. But I have inventory that decreased. So I will subtract that increased. So I have to subtract that number. Both my current liabilities increase. So I add those numbers. Okay. I still have to work on depreciation expense. So I can't add up these numbers as yet. However, I'm going to go down the list and see if there's anything else I need to take care of. I have long-term notes payable that decreased by $8,000. What could have caused my long-term notes payable to decrease? Well, there's only one thing. I paid it off. Okay. So my long-term notes payable, I repaid $8,000, so it's cash outflow. So I've taken care of this number. The common stock, the increase was $50,000. I accounted for $15,000. So it means there was another $35,000 in common stock that was issued. And that must have been issued for cash since nothing else has been mentioned. So I plugged the number over here, 35,000 for this account to work out. I have that number down over here. Okay. Now let's see what else is left over here. Depreciation expense I have to calculate. Retained earnings has been fully taken care of, so I'm going to highlight this to indicate I've done with it. Common stock and land, these three accounts have been dealt with. Investment, this has not been dealt with. Okay. Investment, I had 85, I sold 35, so the balance should be 50. But if it's 55, it means I purchased another $5,000 worth of investment. So I'm going to write investments minus 5 because I purchased, I paid for it. Okay. Notes payable, I already told you that we paid off 8,000. So on the debit side, we had 8 because it's a liability. To decrease it, we will debit it. Okay. So that leaves me with my equipment account, accumulated depreciation on equipment, and accumulated depreciation on building. Okay. My equipment account, beginning balance is 48. I sold $10,000 of equipment, so that should be 38. But it's gone up to 50, which means I must have made a purchase of 32,000. So I have 32,000 over here as purchase of equipment. Okay, so I've dealt with this one now. So I'm going to put this now in a different color so we can see this. And this is the only one we need to worry about. Okay. For building, we can deal with that first. Since there was no change in the building account, no additional information was given. My building account accumulated depreciation increased by 9. I'm going to assume the depreciation expense on that was 9,000. Okay, that's the 9,000 I got from here. Now, I'm going to change the color here. Accumulated depreciation, beginning balance is 14, ending is 21. I wrote off $6,000 of accumulated depreciation because that asset is sold. So the number I have to plug in over here is 13. And I have 13 over here and I have 7 over here. That explains this difference of 6,000 that was sold. So in the problem, if I had been told depreciation expense for the year is 13, and this piece of information was not given to me, that it was 60% depreciated, I'd be plugging this number into the problem. So now that we have that taken care of, what I need to look at is the depreciation expense. 13 plus 9, my depreciation expense is 22,000. So I had to work around this problem to find out the depreciation expense. Now I have taken care of all the pieces of information. I add up my numbers under operating activities and arrive at 48,000 cash provided by operating activities. Investing activities, I do the same. I again have cash provided of 14,000, and this obviously is going to be a negative number. I used 43,000. Now the key is add up these three numbers, 48 plus 14 minus 43. We have to come up with a positive 19,000 because we have a net increase in cash. Okay. So you've seen how to work on a statement of cash flow using the indirect method. For the most part, it's not too difficult if you lay it out systematically and work on it. Remember, everything that you have in your balance sheet, the income statement and additional data should be accounted for. When you're doing the indirect method, the only piece of information we are concerned with in the income statement are the net income number, any gain or sale you have on your non-operating activities, and we want the non-cash expenses. If those are given to me, makes life a lot easier. If not, we have to calculate those numbers. So if you have any questions on this, make sure you ask me before the exam.